Housing finance has posted a stable set of earnings in the fourth quarter in line with street estimates. Asset quality, however, has improved. What's aided the numbers in the quarter gone by and what's in store ahead? Let's try and find that out from the Managing Director and CEO, Mr. Vinay Sah. Also, Shraddha Babla from our research team joins in to take us through the interaction. Shraddha, over to you.
Thank you, Neeraj. Good morning, Mr. Sah. If you could tell us about the prepayment rate during the quarter and whether growth in retail home loan book will continue to remain within that 13 to 15% band.
Prepayments, they continued at the same level. In fact, they may have come down by a couple of basis points, roughly around 9.8 to 10%. Regarding the disbursement growth in the home loans, for Q4, the growth rate was in excess of 17%.
So then is it fair to assume that loan book growth rates overall beyond 15% and margins beyond 2.5% will look improbable at least for FY19?
Loan book growth, yeah. Loan book growth this year we had in excess of 15%. We would be targeting around the same or maybe slightly up by about a couple of percentages in the coming NIMs. It has for our company, it has started on a upward journey. So as compared to Q3, we have increased it by about 16 basis points. As against 2.33 in Q3, it has gone up to 2.4849. So in the coming quarters, I see that probably this upward journey will continue.
Okay, so if you could talk to us about the competitive intensity in the entire home loan segment and what the picture is looking like currently, because there has been a consistent market share loss in individual home loans for LIC Housing Finance, which of course continues to remain a cause of concern. So some picture on the competitive scenario.
See, so many companies have taken licenses for real estate housing finance. So the market share has a direct relation to the number of players, because anyone who comes to the sector will have some share on it. So that I would not say that whether it's a fall of market share is a bigger concern. I'll be happy if we are able to maintain a 16, 17, 18% growth rates in disbursement as far as home loans are concerned. What you asked is regarding the competition intensity. Yes, it's there, but it has always been there. It's not only the housing finance companies, even banks some of the banks are pretty aggressive in it. Especially State Bank is doing fairly well as far as housing loans are concerned. So the competition has been there, but then we have our own strengths, and we would be happy to have disbursement growth rate in excess of 15-16%.
So, but your loan book continues to be driven by those non-housing loans. Isn't there a rising risk element given the increasing share of LAP and developer loans?
Loan book overall, if you see for us, for our company, the developer share is only 5%. It's not more than that. And this is a conscious shift of doing more of developer loans. Yeah, risk associated with it is taken care of by the SOP that we have. We have a very strict underwriting parameters for developer loans. So I don't see much of a risk provided we do the right kind of loans. And on a case-to-case basis, we do go in for these developer loans.
All right. So given consolidation of real estate players post-RERA, have banks started looking at the construction finance segment?
No, in fact, with the coming of RERA, the developer loans are becoming safe for us also. It gives a level of comfort to us also, not only to the customers who buy flats. So that gives us a great deal of comfort if the project is registered with RERA.
Okay. So have you tweaked your lending rates during the quarter? Is there an intention to do so at least in the next 1 or 2 quarters?
We have already done it. We have increased the prime lending rate by 20 basis points starting this month.
So is the worst of margin pressure over? Is yield compression seen coming to an end, or is there actually a threat of borrowing costs going up further?
I think that whatever changes upward, downwards had to have happened. Borrowing, of course, last year full fiscal, if we see, we have brought down the cost of borrowing by about 50 basis points. Going ahead, now, as I said, we have already increased our lending rates, the prime lending rates. So going ahead, I think the margins should improve only.
All right. Sir, would you attribute the improvement in the asset quality in the fourth quarter to it mainly being a seasonally strong quarter, or do you see this sort of a downward trajectory continuing?
No, we are very well faced right now to see that all these things, I mean, all NPA levels, they go down. It's a very conscious effort on the part of the company to see that the NPA levels go down further. I can share with you that out of the gross NPAs, nearly 50% are through the developer loans, and provided, I mean, we are looking at resolution of a couple of big accounts. If that happens, the NPA levels will go down drastically in the coming quarters.
Okay, so has any of the major corporate loans slipped into NPAs in this quarter?
No. There was no addition to any corporate account as far as NPAs are concerned in this quarter.
All right, Mr. Sah, thank you very much for joining us on Bloomberg Quint. Appreciate you taking your time out.